Hey everyone, welcome back to The Next Dollar, your go-to channel for real market insights, gold analysis, and trading strategies that actually make sense. If you're new here, make sure to hit that subscribe button and join our growing community of traders who want to stay ahead of every big market move. In today's video, we're going to talk about something powerful, something that's been quietly predicting major market turns again and again, the 200-week moving average, and how it's currently sending a massive warning signal for both gold, XAUUSD, and the broader stock market, especially tech and semiconductor stocks. We'll break down what's happening technically with gold and XAUUSD, how moving averages reveal institutional psychology, what the US dollar index, DXY, and interest rates are telling us, and finally, what smart traders should be watching next week. So grab your coffee, sit tight, and let's get right into it. Gold's current position, XAUUSD. Let's start with gold, because that's what we focus on here at The Next Dollar. Right now, gold is trading around a very critical zone. We've seen a lot of volatility recently, strong rallies followed by sharp pullbacks. This behavior tells us one thing: institutional accumulation and retail emotion are both active. Now, what's important is that gold continues to hold above its 50-day moving average, which is acting as short-term support. Historically, whenever gold stays above that average for 3 to 4 weeks, we see momentum carry higher. But here's the catch. We also have major resistance between 2,450 and 2,480, and every time price touches that zone, sellers step in. That's where the big players are taking profit. So the big question is, will gold finally break above $2,480 and make new all-time highs? Or is this another setup for a short-term correction before the next major leg higher? Why moving averages matter? Let's break down one of the most misunderstood but most reliable tools in trading, the moving average. Think of it like the heartbeat of price action. It smooths out all the noise, all the emotion, and shows the true direction of the market. There are many types: 20-day, 50-day, 200-day, 200-week. But the 200-week moving average is where the long-term truth lives. Institutions, hedge funds, and big money watch this level like hawks. Why? Because when price gets too far away from it, it's like stretching a rubber band. Eventually, the market has to snap back. Just like you can't keep pulling a yo-yo forever. It always comes back to your hand. Now, the Semiconductor Index, SMH, which includes NVIDIA, AMD, Broadcom, and Micron, is currently 102% above its 200-week moving average. That exact level preceded two major crashes, one in 2021, another in 2022, and now we're right there again. That doesn't mean a crash tomorrow, but it does mean risk is rising fast. Gold versus dollar, DXY. Let's shift to the US dollar index, DXY, because this is the silent driver behind almost every gold move. When the dollar goes up, gold usually goes down, and vice versa. But recently, something very interesting has been happening. Both gold and the dollar have been strong at the same time. That tells us one thing: global capital isn't just looking for yield, it's looking for safety. People are not trusting fiat currencies fully anymore, and gold is still being treated as the ultimate safe haven. Central banks are buying gold in record amounts. Just last quarter, over 300 metric tons were added to global reserves, led by countries like China, India, and Turkey. This institutional accumulation is what's keeping gold supported even when the dollar rises. It's a tug-of-war between monetary power and market confidence. So, when you see gold not collapsing even as DXY goes up, that's your clue. Smart money is quietly accumulating gold, not dumping it. Interest rates. Inflation and Fed policy. Now let's talk macro, because you can't trade gold or Forex without understanding the bigger picture. The Federal Reserve is in a very tricky position. Inflation hasn't fully cooled, yet unemployment is starting to creep higher. This means the Fed can't cut rates aggressively, but it also can't raise them much more. That's the perfect environment for gold to shine. Why? Because real yields start to stagnate while money looks for hard assets. Historically, every time the Fed reaches the end of a rate hike cycle, gold enters a multi-month rally phase. If you overlay the gold chart with previous Fed cycles, 2008, 2015, 2020, the same pattern repeats. Gold consolidates during the hikes, then surges when the Fed pauses or cuts, and that's exactly what we're setting up for right now. Section 5, 13, IT or 15 Rs, technical setup for gold traders. Let's go deeper into the gold chart, XAUUSD. On the daily time frame, the key levels to watch are support, 2365, 12,340, 12,290. Resistance, 2450, 2480, 25 and 20, new highs. If gold breaks and holds above 2,480, we could see a fast rally toward $2,550, $2,600 within weeks. But if it rejects again, look for a retest around $2,350 before the next leg higher. The 200-day moving average remains intact, which tells us the long-term trend is still bullish. But be careful. Whenever price stretches more than 8% above the 200-day MA, a short-term pullback often follows. So, for traders, the smart play is not chasing breakouts, but waiting for pullbacks into key moving averages, then buying strength. The Next Dollar's view on market psychology. Here at the Next Dollar, we always say this. The market doesn't move because of news. It moves because of emotion. Fear and greed are the two strongest forces. When gold breaks out, everyone suddenly turns bullish. When it dips $30, people panic and sell everything. But professional traders, they do the opposite. They buy fear and sell euphoria. The moving averages, the RSI, the Fibonacci retracements, all of these tools are ways to measure emotion on the chart. The key is not predicting. It's reacting with discipline. That's why we focus on technical setups, not opinions. Because opinions don't make money, discipline does. What's coming next week? So what's next? Next week, we've got key U.S. data, CPI inflation, non-farm payrolls, and Fed speakers. These events will drive volatility in both the U.S. dollar and gold. If inflation data comes in hotter than expected, we might see gold pull back temporarily. But if it cools or matches forecasts, gold could easily retest $2,480 and push higher. I'll be watching the 4-hour time frame for momentum shifts, especially how price reacts around the 50 EMA line. If we see strong bullish candles forming above it, that's a sign institutions are stepping back in. Remember, volatility is opportunity, but only if you plan your trade and respect your stop loss. Closing 19-20, Bearish, outro, and CTA. All right, traders, that wraps up today's breakdown. We covered gold's key support and resistance zones, the importance of moving averages, the dollar and Fed impact, and the emotional psychology that drives the market here at the Next Dollar. Our goal is simple: to help you trade smarter, with real market logic and no hype. If you found this video helpful, make sure to like, comment, and subscribe. Drop a comment below and let me know what you think gold will do next week. Break $2,380 or pull back first. And remember, in trading, patience beats prediction. Stay disciplined, stay consistent, and you'll always be one step ahead. Thanks for watching. This is the Next Dollar, signing off. See you in the next video.